Hi guys, we are very excited to see you here in lesson number 10 of Forex series. Originally, this is supposed to be the last lecture in this module, but due to popular demand, we decided to create an additional bonus lecture to share with you more practical knowledge that will be beneficial in your Forex trading. In the previous lecture, we talked about position and risk management, and in here, we will discuss a few practical rules of Forex trading. Before we go into discussing the individual rules, there's one thing you need to keep in mind. Always plan your trade. If you fail to plan, you are planning to fail. The same thing applies to Forex trading. Rule number 1. Avoid losing big. There are only 4 possible outcomes after you finish a trade. Win big, win small, and lose big. All you have to do is to eliminate that lose big and make the outcomes the other 3. That is, win big, win small, or lose small. How do you do that? Place a stop loss on every trade you make. Rule number 2. Win big sometimes. While it is impossible to win big every time, you must be able to do so at least sometimes. Retail traders have a tendency to keep the losers and sell the winners too soon. This is not a good habit. A good one will be to keep your profit run and cut your loss as soon as possible. Rule number 3. Trade on longer time frame. Unlike stock market that only opens several hours a day, the Forex market opens 24 hours a day and 5 days a week. And because of this much longer open hours, many Forex traders trade frequently, even day and night. At Market Newbie, we do not think this is a good idea. Some of you might have encountered a situation like the one that I'm about to describe. You trade a currency pair, let's say Euro to USD currency pair, and the market goes in favor of your direction. However, you only earn for about 100 pips and you immediately close your position. You start to trade other currency pairs and you only do short terms as well. In these short terms, sometimes you win, sometimes you lose. So after about a month, even if you're still in a winning zone, you have only won very little cumulatively. However, if you have kept the Euro US dollar currency pair for a month or longer, you would have ended up winning bigger. This is because short-term trend is much harder to catch than long-term trends. Short-term trades cost more commission, time, as well as energy. And for newbie, it is better to trade on a longer time frame. Rule number 4, the criteria. This is the most important rule that we need to remember and apply in our Forex trading. There's only one thing you will have to remember every time. The potential profit that you will get has to be always bigger than the potential maximum loss. At Market Newbie, we recommend at least a 5 times larger potential profit as compared to potential loss. Once you're more familiar with Forex market and if you're doing good enough, you might consider to reduce this number to 3 times instead. This means if you don't see a potential big profit with a relatively small risk, do not proceed with the trade. Sometimes, if you're not sure whether your analysis is correct, do not proceed with that trade either. Now, let's take a look at how we can apply this criteria. Currently, Euro to US dollar currency pairs traded at 1.1568. Based on her analysis, Lisa believes that this currency pair will go up to at least 1.2100, and she's pretty confident in that analysis. She decides that the 1.1500 is a good place to buy. This trade may give her a potential 600 pips profit. How do we arrive at this potential profit? Here's a calculation. The previous important support position is slightly above 1.1400, so she set her stop loss at 1.1400. Therefore, the potential maximum loss she is taking is 100 pips. And here is the formula how we arrive at this calculation. In this case, because the potential profit, that is 600 pips, is 6 times the potential loss, that is 100 pips, which meets the criteria. potential profit is more than 5 times of the risk. So Lisa could proceed with this trade. However, if her potential profit is only 200 pips instead of 600, it will be only 2 times her maximum potential loss. In this case, Lisa should not proceed with the trade. The criteria of maximum potential profit is at least 5 times more than maximum potential loss has a caveat. That is stop loss. Let's consider this following situation. Lisa sets the stop loss at 1.1470 for the currency pair she wants to trade. Her maximum loss would be 30 pips. Her potential profit would be 200 pips. When we apply that criteria, we can see that the potential profit is actually 6 times more than her potential loss. The question is, should she trade or not? The answer is no. This has to do with stop loss. If Lisa sets stop loss at 1.1470, it's too close to her entering point, which is 1.1500. Therefore, her stop loss line would get hit too easily. Daily fluctuations for a currency pair normally range from more than 50 pips to 200 pips. Setting a stop loss that's less than 50 pips is really unrealistic because you might end up closing your positions most of the time, as your stop loss gets hit. The choice of stop loss point has to be based on your analysis and how good you are in catching the entering point. This needs practice. Some people are pretty good at getting a good entering point, so they can set a smaller stop loss. For those that are not quite good, they need to be more patient, wait for bigger chances, and set a larger stop loss. The most important thing is that you need to plan your trade according to your capacity. The same philosophy applies to setting take profit point. The rules, the criteria, and stop loss are actually all interconnected. Stop loss helps you eliminate the lose big from the 4 possible outcomes that we discussed in rule number 1. Also, you can slide your stop loss when the market goes in favor of your direction. This way, you get protected even further. Remember, you could only slide your stop loss into the direction that will reduce your risk, not the other way around. For example, in Lisa's case, once the market price goes higher than 1.1500, she could move the stop loss, which is 1.1400 upward to a price, let's say 1.1430. The criteria of potential maximum gain more than 5 times the potential maximum loss helps you with rule number 2, that is to win big sometimes, as well as rule number 3, to trade on longer time frame. This criteria gets you focused on trades that will give you bigger rewards instead of those that may not. For newbies, this is very important because we tend to make more mistakes than skilled traders. As mentioned at the beginning, we will have a bonus video for the series. There, we will teach you how to plan your Forex trading. For more educational materials, visit www.marketnewbie.com, our Facebook page or Instagram page. See you in the next lecture.